What's going on, guys? Brian's here. Today is Monday, April 1st, 2024, and the market is closed. I figured I'd hop on and record a pretty quick video on a bull put spread that I ran here today, also known as a put credit spread. It was a 0 DTE put credit spread on the SPX. I rarely do videos on verticals as I think verticals are very simple to trade. They are the building blocks to spreads, and I think there's enough content on YouTube for verticals. I plan on sharing a lot more verticals for the rest of this year, however, just because they're very simple to explain. I'm in a sense shorting a put and then buying another put right here. The distance between each strike price is how much margin is required, and then you minus the credit, and that's how you get your max loss. So it's a very simple calculation. Why did I run a put credit spread today? We'll jump straight into the charts. This is the time in which I opened the trade at 11:21. This was the profile at the time. And then this was one of the first reasons in which I decided to run the trade. As we can see, this is the ES, so the S&P 500 index futures. The market was selling off pretty aggressively, starting from pre-market. And this was the volume profile for last week. This was the point of control. Usually whenever price sells off into an area where there's a lot of high volume nodes or a lot of high gamma, or if it's a level with a lot of support, price will consolidate depending on how aggressive the sell-off was. So if we jump to the chart, let's actually make this full screen here. This is the SPX on the left-hand side. We can see that this is a pretty aggressive sell-off, and there's a lot of momentum behind it, just based off the fact that there's a lot of red candles. So we have 1, 2, 3, 4, 5, 6 red candles in a row, and I opened the trade before this candle was actually closed. I've done a video before on taking counter trend trades. I've mentioned using the 15-minute time frame. If you wait for that first 15-minute candle to actually close, if it is the reverse of the trends, that is usually a first indication that the trend is losing momentum or it's losing steam. However, I opened the put credit spread today without waiting for this candle to actually form, which is usually dangerous or risky, but I didn't want to miss out on the opportunity as I understood the risk. The put that I sold was the 220 put right here. So 5220. So the 220 put, and the put that was purchased to complete the spread was the 215. So I was short the 220, long the 215, 5-point difference between the two strike prices. This again is the profile for the spread right here. And this was price action. If we zoom out again and let's actually maximize the ES, we can see this is obviously the market's closed, so we have all the price action, what happened after the fact. But obviously when I opened the trade, there was no way to know what exactly was going to happen by the close. I just wanted to point out the significance of using the volume profile, not necessarily to take a bounce trade by buying calls. There was too much momentum in the morning to think that the market would just have a somewhat complete reversal all the way back up to the high of day. So I had ruled out buying calls, and I decided usually if I don't think there's enough reasons to expect some sort of a bounce or V-shaped recovery intraday, the preferred method is to just sell some puts, because if the market is going to consolidate like it did today, if you buy calls, even though you're right, that momentum is slowing down and this can be the bottom for the day, you're going to end up getting chewed up by theta, and the calls actually won't make that much money because time is passing by. This creates the perfect scenario to actually sell some puts. Usually you'll see technical patterns will form after some sort of aggressive move in price action. Some people call this the impulse move. This just to me reads to me as momentum. Take a look at this day. We had an aggressive move up, and then we had consolidation. Here's an aggressive move down, and then we had consolidation. We have technical patterns that are forming after these moves. I like to sit back. I'm a very patient trader, and I will wait till there's enough reasons or until I have enough conviction to actually enter a trade. Now, why would I choose the 220 put to actually sell? Let's take a look in my notes here. This is the delta. So it was about a 0.23 delta at the time, which is not very aggressive. It's not really that far out the money. Some people will sell puts that are, 15 delta. Some will sell a put that's at the money. Some will sell a put around a 30 delta. There's all different methods for people out there. The fact that it had a 23 delta was not the exact reason in which why I ran the trade. I generally like to try to receive at least 50 cents credit whenever I'm running 0 DTE credit spreads, such as a bull put spread. So that's the first indication to me. If it's less than 50 cents, then it's not really going to be worth it, in my opinion, even though your probability of success is going to be pretty high. What gave me extra conviction to actually run the trade, if we head to some of the SPX data right here, let's take a look at, this is the timestamp in which I was looking. So 11:15, let's just double check right here. By the way, this is the quant trading app Discord that I'm just showing some of the notes from. And we have, this is what I shared here. This was at the 11:15, 11:24 when I shared this. I opened the trade 11:20. I was already looking at this at around 11:15, and then 11:24 just shared this so people can understand what I was looking at. So let's just go to the channel where the information is actually coming from. That's right here. And the first thing I took note of is the fact that we have max pain at 230. So this is generally going to act as some sort of support. And then we also have the highest negative gamma strike right here. And this is also the strike price at the time that had the highest put volume. Whenever I see a lot of convergence around one strike, and we already identify that there's been a lot of momentum in one direction, price is going to stall out inevitably, especially when we're talking about the S&P 500. This is not a meme stock. This is not a high volatile stock. This is the entire market. The market won't go straight down and it won't go straight up without eventually having some consolidation. You can find a meme stock that can be down 60% in one day, but that won't happen with the SPX. And if it does, the circuits will be halted. Market makers will find some sort of way to pause the markets. They won't allow it to crash. There have been flash crashes before throughout history. But anytime that's happened, they built more security measures to try to prevent it from happening again. So in this case here, we have this aggressive momentum to the downside. Price hits what should be about the 1 sigma close for today. We have the max pain strike here. So we have a ton of potential support around this strike. We have a lot of negative gamma here. We have a lot of put volume happening here, and this is the 1 sigma range for the day. So selling a put, the 220 put, which is below all of this potential support after an aggressive sell-off right into the strike price, where quant trading app is in a sense saying is the 1 sigma close for this type of day, provided enough security. So if we continue to scroll down, and let's just see how things played out towards the end of the day. By the way, I'm just scrolling past some of the gamma. So I've covered gamma exposure in a lot of the other videos. I figure let's just scroll to the end of the day and we can see what actually happened. So as the trade was open, look at where the first 15-minute green candle actually formed. It happened to form right at where the 1 sigma close was for today. Price had already sold off past the expected move for the open. The market was not expected to sell off this far based on the options market, based on the implied volatility for the 0DTE SPX options. So this is already strange, and we can interpret this as price ended up going a little too far past what it was expected. So where is it naturally going to stall out? It makes sense that it would happen right here. And that was one of the reasons why I also decided to sell some puts. On top of that, look at where the bottom ended up forming, right around 230. So we had a little bit of a double bottom right here on a smaller time frame. Obviously, when we're looking at a 15-minute time frame, it's hard to see that this is a double bottom. But if you're looking at a 1-minute time frame or a 2-minute time frame, this will look more like a bounce and a bounce, and then price reversed. Later on, price revisited 230, and then we can see buyers were defending this price again. This is our max pain strike for the 0DTE. So selling the put down here was pretty safe. And if I remember correctly, the premium from the puts were already down around 45 to 50%. So the profit target was hit well within an hour. I held it a little bit longer. Normally I wouldn't hold that long, but when I have that much conviction, it makes it a little bit easier to hold. As we can see, the puts obviously expired worthless because the SPX ended up closing at 243. So the 222 put never went in the money. So for selling a put credit spread like this, you end up collecting 100% of premium if you hold until the close. But generally, a profit target or a safe profit target is going to be around 50% of the premium whenever you're looking for some sort of an exit strategy. In this case here, some people will use 3x. Whatever you're looking to make. So if you're looking to make, 30 cents on the trade, your stop loss might be 3x that. Some people will use 3x what the max profit is. So if you're looking to make 50%. So in this case here, if you're looking to make 50 cents, which is 100% of the trade, you 3x that. That means your stop loss will be about $1.50. When it comes to risk management, everyone has their methods. In this case here, I was willing to let the trade expire in the money if it needed to. I had enough conviction to think that there was no way this put was going to be in the money for today. That is a dangerous thought process to have, especially if you are a beginner. Never assume you are safe in these types of credit spreads unless you have enough experience or unless you are willing to accept your maximum loss here. What are your preferred methods for running credit spreads? Leave your comment down below. I would love to hear. If you guys have any questions, leave comments down below or ask on the Quant Trading app Discord. Thanks for watching, guys, and I'll catch you in the next one.